You're tuned in to More Living with Jim Brogan, broadcast live from the Brogan Financial Studios at News Talk 98.7, where old-fashioned values, expert knowledge, and genuine understanding come together to give you the retirement straight talk you deserve. Jim's a former National Advisor of the Year recipient and a financial educator, and he's here today to talk about how you can live out the best years of your life. Jim and the Brogan Financial team have been helping retirees and pre-retirees across the Southeast for over 20 years in their pursuit of financial independence. You can reach them during the week at 865-862-6800. So sit back, relax, and get ready to learn, because More Living with Jim Brogan starts now.
Hello, East Tennessee. Welcome to More Living with Jim Brogan, where it's all about living the best years of your life your way. As you listen to News Talk 98.7 WOKI, you know, it's always easier when markets are going up, right? We've continued to hit new all-time highs throughout this year. You know, we had the pullback in April based on the tariff proclamations. We reversed course about 10 days later. And in spite of all of the economic uncertainty, geopolitical instability, the market has continued to press all-time highs. Long-term rates have continued lower. The market has had to endure some weakening, more macro reports. We've had stickier inflation than expected. We have had a slowing jobs market. And now we have a government shutdown. And the market appears to have shaken off many of these concerns. Much of that is based on the heels of continued strength in the AI narrative. Now, that does not mean that the market will not have a pullback. Market pullbacks and corrections can be very, very healthy. But the main topic of this week has been the government shutdown. And so what I want to lead with today is what's the latest on the government shutdown, and how might it affect your money, and how should you be reacting to these types of macroeconomic things that are happening. You know, the latest effort to reopen the federal government collapsed on the Senate floor yesterday, and it left lawmakers at a standstill and investors resigned to a shutdown measured not in days but in weeks. So we had the fourth failed vote since the standoff began. That happened yesterday. It kind of underscores the depth of the partisan division. As far as financial markets, the debate is no longer about whether the shutdown ends swiftly, but how long the deadlock will persist. And if we look at the Treasury markets for Treasury bonds, analysts at Morgan Stanley point to options pricing, which indicates investors expect this impasse with the federal government to last at least 10 days and pushing as many as 25 to 30 days. So, you know, this may be a stickier government shutdown. Shorter interruptions of less than 10 days are now viewed as improbable. While a shutdown stretching more than a month is unlikely but could still happen. So how might markets respond to this? Now, as of this week, markets haven't really been too concerned. I think it's very important to remember that the market is not political. It doesn't care about draining swamps. It doesn't care about political retributions. It doesn't care about woke campaigns or anti-woke campaigns or DEI initiatives. The market in the long term only cares about policies that do two things. One, increase or decrease earnings, corporate earnings. And then two, support growth of U.S. company earnings or hinder that growth. You know, any political movement or agenda that is viewed by the market as getting in the way of better earnings and growth will be viewed as negative and be a headwind on risk assets like stocks and equity markets, regardless of whether those policies are from Republicans or Democrats. And this is the way we must view political coverage right now during the government shutdown and really over the next year and the next 4 years. And it helps us cut through the noise and stay focused on policies that truly affect impact markets. Now, interestingly enough, when we look at prior government shutdowns, and I'm looking at the government shutdowns all the way back to 1976, the government shutdown headlines always spark fear. But history does tell a calmer story. Looking back at every shutdown since 1976, the S&P 500 stock index has been flat on average during shutdowns, literally flat, like 0%. And the week after the shutdown, the market is usually up a little over 0.5%. And then the 10-year Treasury bill barely moves in these past government shutdowns. In other words, the market tends to look through government shutdown noise rather quickly. And this goes back to what I was saying about how markets really ultimately what affects markets in the long term. It's corporate profitability and growth of corporate profitability, and the market is very apolitical. So when we see policies, how is this likely to affect corporate earnings is really what the markets are looking at. So, I get asked all the time, Jim, with markets hitting all-time highs, are we due a correction? And I've been getting that more and more these last couple of months. The answer is we don't know when we'll get a correction. It is important we don't fight the markets. One of the real keys in being successful in stock market investing is that you are invested in the markets when we have bull market runs. And I don't think we can time where the bull market runs are and when the bear markets are. And so if we're going to have to be sure we stay invested in bull markets, that means we're going to be invested in market corrections and bear markets. And so I think it's critical to try to look through the noise of current macroeconomic conditions, geopolitical strains, all of those things, and realize, we don't invest in the market for what our money's going to be worth in a month or 3 months or a year. We invest in markets for what our investment may be worth in 5 or 7 or 10 years, or for younger investors, maybe in 20 or 30 years. And I kind of hearken back to, the real estate crisis in 2007 and 2008. I was living in West Knoxville at the time, and, people around me were talking about in our neighborhoods were talking about, our home values have gone down. Well, I wasn't too worried about that because I wasn't anticipating I would sell my house. And in fact, I didn't sell my house until 2014 when I moved out to Blount County. So, and by then my house had come back and had gone up in value. So there's a lot to be learned from that. We don't get a report or a market report or update every single day on our home value. We do get a report on our stock values, or our mutual fund values or our bond funds or whatever we're invested in. Those things we get. Most investments, we get that they're marked every single day to market prices. So we see those fluctuations. And that can be good. It provides more transparency. Publicly traded markets typically have greater transparencies just in the vetting of those investments, and then we know what they're worth every single day. But that can also lead to behavioral issues, and we just have to be very careful how we react to short-term news and realize that we take risk with investments. It's got to be with the mindset of where we're going to be. The minimum for me is 5 years from now. Trying to invest in the stock market with a time horizon of less than, 4 years, 5 years, if you're looking at what's my money going to be worth in 2 or 3 years, that can just be more of a crapshoot because we just don't know. Now, if you're getting ready to retire or you're already retired, what does that mean for you? It means you need a plan that can handle short-term market instability. And we're going to get into that a little bit in this show. Markets in the short term are very volatile. And so bottom line is you don't need to be depending on market investments for short-term income or for short-term needs. However, over the long haul, for a 65-year-old retiring today, you're, a married couple today, one of you is probably going to live 25 to 30 years. And that's what the data says. Into your 90s, one of the spouses for a married couple age 65 today, one of you is going to live into your 90s. And inflation becomes a very powerful opponent over the long haul. Inflation is not something that affects us all at once, like the stock market volatility. It just kind of slowly eats away. It's like a thief in the night. It eats away at our income. So we've got to have a plan to be able to beat inflation long term. We're going to get to our first break, and when we come back, I'm going to talk about some of the hidden costs of inflation in everyday life, and then ultimately, how can you balance all this, the need for increasing income over time with the reality of market instability in the short term and volatility. And while our government shutdown is not likely to affect market volatility in the short term, it does have people on edge and worried. So how do you plan through all of this noise? So stay with us. This is More Living with Jim Brogan right here on News Talk 98.7 WOKI.
Welcome back to News Talk 98.7's Brogan Financial Studios, where Jim Brogan is coming to you live with important news and advice to help you achieve your dream retirement. Get ready to learn and live. Here's your host, Jim Brogan.
Welcome back to More Living here on News Talk 98.7 WOKI. We're with you every Saturday, 9 to 10 a.m. and again from 3 to 4 p.m. You can also check us out online. Go to broganfinancial.com. We've got a wealth of information. If you click on our resources tab, you can find out information about our classes through both the University of Tennessee and Mississippi State. We also have blogs. We have a lot of guides up on our website to help guide you through life and make smart financial decisions so you can be informed. Let's talk about the hidden cost of inflation in everyday life. Groceries, utilities have really been creeping up again. Inflation isn't just a number in the news. It's the quiet thief. It chips away at your purchasing power. Every time you fill up your car, flip on a light switch, or walk down the grocery aisle. And while headlines focus on overall inflation rates, the real story is in the everyday expenses that hit your wallet the hardest. Recent data shows electricity prices rising faster than general inflation. Grocery costs continue to push higher. Now, we have had some relief on gas prices through the summer. But whether you're enjoying retirement or planning for retirement, understanding these hidden costs and implementing smart strategies can help you maintain your lifestyle without constantly worrying about your budget. So let's talk a little bit and explore how inflation is quietly affecting your daily expenses. And then I'll share practical strategies to protect your financial well-being. Let's start with food prices. Food prices have become one of the most visible indicators of inflation's impact on our daily lives. And there's more to the story than just higher prices. There's also this phenomenon called shrinkflation that's quietly affecting what we get for our money. What is shrinkflation, and how's that all a component of all this inflation? Food prices in July this summer rose 2.9% compared to the previous year. Food at home prices have increased a little over 2%, 2.2% year over year, and food away from home, restaurants, saw higher increases at almost 4%, 3.9%. Beef and veal prices are predicted to rise 9.9% in 2025, and of course egg prices were well over 50% price increases. So we're continuing to see our groceries go up. And I know, when we hear 2, 3, 4% increases, it feels like a lot more. And that's because we're on top of the 8% increases we had a couple of years ago. Now, the shrinkflation effect. 1/3, when you go to the grocery store and you look at our top 100 common consumer products, 1/3 of those products have shrunk since the pandemic. Meaning, how much do you get in the package that you buy? And it has shrunk. For example, coffee bean packets used to be 16 ounces. Now they're on average 10 to 11 ounces. But they used to be a full pound. Companies are reducing package prices while either keeping prices stable or even slightly increasing the prices. Shrinkflation makes it look like you're not paying much more, if any, but you're not getting as much product. And this practice is absolutely not going away, according to industry analysts. More shoppers are choosing to purchase less expensive store brands. Shoppers are shopping at multiple stores to find deals, buying in bulk when possible. I think it's always important to have a list, a shopping list. Don't go to the stores when you're hungry, as an example. So there's a lot of great tips there. And in our next segment, I'm going to dive a little bit into that. We're going to have an expert. We're going to have Andrew Henderson with Fitness Together call in, and we're going to talk about how you can make wise decisions in your shopping and in your food purchases to be healthy, but then also to fight this inflation battle. Now, meanwhile, electricity bills have been quietly climbing higher. Prices are up over 6% in some regions. Electricity prices rose 4.5% in the past year, which is double the overall inflation rate. Average household electricity bills could rise as much as $219 in 2025 compared to 2024. So we're starting to see a lot of impact on our utilities prices with the growth of data centers. You know, when we look at the massive need for electricity with data centers, artificial intelligence, and some of the developments we're seeing with technologies, it really is putting a stress on our electricity grid. Natural gas costs just jumped over 40% in the first half of 2025. Utility infrastructure upgrades, replacements. 1 in 6 households are expected to continue to struggle to pay their utility bills. So we're feeling this pinch on higher prices. I don't think there's any question about it. What can you be doing to fight this battle with your financial plan specifically? The big picture is, how do you protect retirement income from the eroding effects of inflation? 57% of Americans say inflation is their main obstacle to a comfortable retirement. So how do you plan for this? I think one is, how do you balance your investments? And, you know, what a lot of people do is they look at balanced investment strategies, and we still often see this classic 60-40 mix of stocks and bonds. 60% stock funds, 40% bond funds. You know, when we look at it historically, equities have been the best way to maintain purchasing power and to increase purchasing power over time, historically beating inflation. But then the problem is, of course, as I mentioned in the first segment, in the short term, we have no idea what we're going to get. So it is crucial, I think, one thing you've got to remember when we add bonds to our portfolio, and I'm not saying you should not add any bonds, but bonds historically do not beat inflation. The 100-year return of Treasury bonds has been basically what the inflation rate has been. So if you hear things like nominal return and real return, nominal return is the return that you made. You know, if you made 4% on a CD, that's the nominal return. The real return is how much did you beat inflation. If inflation is 3% and you earn 4%, your real return is 1%. Well, over the last 100 years, the real return, in other words, how much did Treasury bonds beat inflation? It's 0%. What bonds sometimes do is they can provide a little bit more short-term stability because, as I mentioned earlier, equities are extremely volatile and unpredictable in the short term. Now, there are other ways to add that stability with greater levels of diversification that I've talked many, many times on this program. And there is a need to decrease volatility in a portfolio as you get closer to retirement. But we have to be very, very careful that we don't add a high mix of bond funds to help balance risk, because over time they're going to produce a lag on performance. But then with the stock market being unpredictable and volatile, how can you depend on short-term income? You certainly don't want to depend on the stock market in the short term for stability, because there is none. So we've got to structure, and you've heard me talk about it, we've got to structure our investments in buckets, if you will, based on when we're going to need that money. Money we're going to need in the next 4 or 5 years has got to be protected or else very stable. Because, one of the fundamental rules of wealth management 101, is don't spend an investment loss. In other words, it's okay to sell something when it's down and reinvest it, but you never want to sell it when it's down and spend it. And that means, what do you do for income when markets are choppy? You need to have safe and protected and more stable holdings that you can pull from when we inevitably have those periods. So you've got to invest risk money with confidence, knowing that you're not going to need that money for 5 or 6 or 7 years. And you do that by creating short-term stability with short-term holdings. Now, granted, those holdings aren't going to make as much over time to beat inflation, but they provide the short-term stability. But you also don't want to have too much money in those instruments, because if you do, you're going to fight a losing battle against inflation, if that makes sense. So having the right kind of balanced portfolio where you don't just load up too much in bond funds, because they do historically have had a drain on long-term performance. Now then also, having a safe withdrawal rate, typically around 3 to 4%. So in other words, if you have $1 million, then in year 1 of retirement, you would draw between $30,000 and $40,000 from your investment base, if that's your investment need, and then over time you would increase that to beat inflation. If you have a 4.5% or 5% withdrawal rate, doesn't mean you cannot be successful, but it's going to be more of a battle to try to beat inflation with that type of a withdrawal rate. Also, delaying Social Security, or at least considering your Social Security strategy, that's a better way to say that. Considering your Social Security strategy to maximize your ability over time to generate income. And we don't know when we're going to die, so we've got to be careful we just don't go for the money grab at the first chance. Now, I do think that this idea of everyone should delay to age 70 is overblown. I think that there's way too much out there that just says delay to 70, delay to 70. I mean, not everybody can afford to delay to age 70. If you retire at 64 and you need income and you delay your Social Security, it doesn't do you any good if you spend all your money before you turn 70, or most of your money. Likewise, spousal strategies, understanding how widow and widower benefits work, all of that's crucially important in your Social Security strategy. But in the end, your Social Security election is a great way to fight the perils of inflation. And actually, next week, we're going to have our entire show is going to be on Social Security election, understanding the Social Security system, what are advantages and disadvantages of drawing at different times, how do we manage a lot of these things I'm talking about right now. So we'll have that next week. But these are just some ideas of how you can be aware of the thief in the night that is inflation, and how you can be battling that in your financial plan. Now, I mentioned the groceries. Grocery prices continue to go up. We see the shrinkflation, which is very frustrating, where you get less in the product. The packages we buy are smaller now, but the prices are not lower. How can you manage food and grocery costs and yet still maintain health, fitness? Because the reality is we live in a world that we like cheap and easy and convenient and fast. And that's not a good recipe for health. Healthy foods tend to cost more, and we're seeing inflation. So how can we fight this battle? Stay with us. We're going to have special guest Andrew Henderson on. He's with Fitness Together here in Knoxville. They have 4 locations, and we're going to talk about how to manage your grocery costs and your health together. So stay with us. This is More Living with Jim Brogan here on News Talk 98.7 WOKI.
Welcome back to News Talk 98.7's Brogan Financial Studios, where Jim Brogan is coming to you live with important news and advice to help you achieve your dream retirement. Get ready to learn and live. Here's your host, Jim Brogan.
Welcome back. This is More Living with Jim Brogan, where it's all about living the best years of your life your way. As you listen to News Talk 98.7 WOKI, I do want to mention very quickly here, my last class for the fall through Pellissippi State University, or Community College, excuse me. Thrive Financially in Retirement. It's coming up on Tuesdays, October 21st and 28th, so about 2.5 weeks. 2 2-hour sessions at the Hardin Valley location. It's at 6:30 p.m. And if you want more information on this course, Thrive Financially in Retirement, you can go to PellissippiRetirementPlanning.com. Again, PellissippiRetirementPlanning.com, and you can download a syllabus and click to register. The course fee is $59. Pellissippi does pay or provide a discount for a married couple for both of you to attend, so I'd love to see you at that class, where I'm going to cover 7 major areas that I think everybody needs to know about in order to be successful in their retirement. In that second segment, we talked about some of the ravages of inflation. It is a thief in the night. I like to call it It's like the cholesterol of retirement planning. It's a silent killer. It doesn't happen all at once like a stock market decline, but it sneaks up on you and you wake up one day and where's your money going? And I mentioned grocery prices. Grocery prices continue to go up. Food costs, shrinkflation, as I said, 1/3 of our most common 100 consumer products have shrunk. The packaging size has shrunk since the beginning of the pandemic. We are pleased to have Andrew Henderson, a long-term guest of the show, a friend of ours, mine and Dee Dee's, that owns Fitness Together here in Knoxville. They have 4 locations, and he is quite the expert on fitness, nutrition, all of those things. Good morning, Andrew. Welcome to More Living. It's great to have you back with us.
Good morning, Jim. Good morning, Knoxville.
I was talking there about the increase in food prices, Andrew, and food prices, we saw 3% increase year over year this summer. We are seeing even higher prices when we eat out. Protein sources like beef and veal are up 10%. How can families, when we shop, what are some effective strategies for managing our costs without sacrificing nutrition? Because we do live in a world where everybody wants fast and easy.
Yeah, no, that's a great question. And the cost of living certainly has skyrocketed, it seems like, over the last 3 to 5 years for a lot of different reasons that I'm sure you've covered. So, there's so many different tips, but I want to try to keep it simple. So, the first step, I think, is to plan ahead. There's a saying, people don't plan to fail, they fail to plan. And I see a lot of our clients, they don't really know what they're going to have for dinner that night. They don't have a grocery list when they go to the store. They kind of wing it. And so what happens is they wind up buying things that they don't really want or that aren't particularly healthy for them because they fall prey to the impulse buy. So my first tip is to plan ahead for the week and have a list when you go to the store. And as you're planning your meals, try to focus on I think the centerpiece of your meal should be a good, healthy protein. B, the second piece should be good, healthy vegetables or fruit, and then carbohydrates as kind of an accompaniment to those 2 other things. So I would keep it simple. and plan to start with.
Yeah, I think planning ahead, having a shopping list, and don't shop. I said it in the last segment, but don't go grocery shopping when you're hungry. That's a recipe
That's
for
right.
disaster.
Yeah, you'll wind up with all kinds of stuff in your cart you don't need.
Yeah, but also if we plan ahead, we're less likely to be eating out. And interestingly enough, the food at home prices have increased a little over 2% year over year, but eating out, food away from home prices, food away from home, we've seen increases of about 4% per year. And of course, these are all on top of the increases we saw a couple of years ago of 8-9%. I think people already kind of struggle. Where can we get good quality products?
Yeah.
And we all know the adage, shop in the outsides of the grocery store, not the inside aisles and the processed foods. But I think planning ahead and having a budget is one of the most important things we can do.
Yeah, you probably heard of Dave Ramsey. He's a big believer in going to the store with cash and not using a credit card. And research shows that people who use credit cards typically spend more than people who use cash when they go to the same store because it hurts a little bit more to hand over that cash. Credit cards are an easy thing to not worry about now. We'll deal with it later. I mean, some people are putting their groceries on a buy now, pay later, which is, U.S. debt is at an all-time high, so we can talk about that later. I think there are some ways to do it, though. There's certainly some good loyalty programs. We shop at Kroger quite often, and they send us weekly or monthly coupons, and it's based on things we're already buying. So there's a quick way to earn, some discounts that way. We're not above using coupons or loyalty programs. You can shop sales. My mom used to grocery shop at 2 or 3 different stores every Sunday based on what was on sale on the circular. So, sometimes you have to look at it like, a penny saved is a penny earned. Well, if you need to make more money, one way to do it is by saving it, and it may take you a little bit extra time, but it could be worth it in the long run. You could literally save hundreds or thousands of dollars a year just by being a little bit more thoughtful and putting time into your planning aspect of shopping. You already mentioned it. That's the shop the perimeter. I think a lot of times people get fooled, too, when they grocery shop. They look at the total cost, but they don't look at the unit cost, and that's how much it costs per ounce. Sometimes we're thinking we're getting a great deal when something is on sale or we buy a larger portion, and we think it's going to be cheaper than if we buy a smaller portion. But make sure you look at that price breakdown on the grocery store aisle that shows you what you're paying per ounce. That's really where your savings are going to be.
Yeah, and that's where we see a lot more of the shrinkflation. It's really eye-opening how these brands have been decreasing the size of their packages while either maintaining the price or even increasing the price. It's just unbelievable to me.
Yeah, I think the days of the half gallon of ice cream are just about gone except for Bluebell, and they certainly charge a premium for it. It's basically a quart and a half now instead of 2 quarts.
And the other thing is you mentioned planning ahead, and I think having a budget, because, it's interesting. In the last segment, I'm going to talk about a recent survey of Gen Xers that feel like poor financial decisions have cost them upwards of, on average, $100,000 towards their retirement planning. And one of the reasons is people have a tendency to feel like budgeting is only necessary when things are super, super tight. If you're really, really having problems making ends meet. But the reality is, especially with food costs and especially when we want to maintain great health, having a budget and prioritizing and doing things like, not going to Starbucks as much, cutting back on eating out, some of those things, it really is vitally important.
Well, if you don't think of it as saving $10 at the grocery store, think of it as, well, if I take $10 and give it to somebody like yourself, in 20 or 30 years, that could be worth $100, right? So it's not what the cost is now, it's what the potential of that money is later. And that takes a little bit of mindset as an investor. That's how I try to look at things, though. It's not the savings now, but what is that money actually worth and what power does it have? Another tip, a pretty basic tip, is avoiding waste. I think a lot of times people buy the foods that they don't eat all of it. For example, we may buy a bunch of bananas and they start to turn brown. I don't like brown bananas, but as soon as they start to turn brown, we put them in the freezer. We use those for things like smoothies, for example. Or if the strawberries start to get mushy, we put them in the freezer because I hate throwing food away. My wife can attest to that. She yells at me for eating leftovers that have been in the refrigerator too long. But if you can avoid waste, that's going to save just hundreds of dollars a year at least. Sometimes it's better to buy frozen produce like frozen berries or frozen spinach rather than buying fresh because it's actually fresher because they picked it and they flash frozen it right away rather than it sitting in a truck and getting shipped cross country. And by the time you get it, it's only a couple days away from being spoiled. So if it's something you're not going to eat right away, buy the frozen version of it instead of the fresh version. You'll wind up saving a lot of money just in waste that way.
And Andrew, do you have any other practical meal planning strategies? I mean, I know for Dee Dee and me, it helps when we do, like on a Sunday afternoon, we do food prep for the week. Do you have some meal planning tips in terms of preparation?
Yeah, I think again, find foods that are healthy. Focus on a lean protein, and you can do it. Protein can be very expensive if you're buying super high end cuts, but maybe focus on things like buying a pork loin instead of the tenderloin. It's equally as tender, equally as delicious, but it's about half the cost. Maybe buy a sirloin steak or a sirloin cut of beef rather than the super tender filet or the T-bone, which is A, fattier, and B, it costs 2 to 3 times as much. Marinate it for 24 hours. Put it in the slow cooker. You'll get an equal amount of health and protein and just as much flavor without spending all the money. So, look for things that work with your budget. Find things that are easily frozen and then reheated. I like glass containers, so if you're going to be meal prepping and heating it up at work, use a glass container instead of a plastic container for different health reasons. Use vacuum sealers. So, if you buy a big cut of meat and you're not going to eat it all, we'll cut it into portions that you might want to put on the grill later. Use a vacuum sealer so it doesn't get freezer burn, and then put it in your freezer and then label it. And then the next time you're ready to grill out, get it out the day before, let it defrost, and then you'll be ready to cook. So there's a few tips for meal prepping. Hopefully that helps.
Yeah, those are great. I just think, we talk about financial planning all the time, on this show, but I think probably maybe the number one thing we should invest in is our health, and that's fitness, that's nutrition. I heard a trainer one time, Andrew, said 70% of how you look and how you feel is what you eat. And nutrition is so important. Quickly, Andrew, share with our listeners, you own Fitness Together. You have 4 locations in Knoxville, one-on-one training and small group training. How can people learn more about Fitness Together?
Yeah, and we also have the services of a registered dietitian, Heidi, who's wonderful. The best way to find out about Fitness Together is to visit our website. It's knoxft.com. So knoxft.com.
knoxft.com. Andrew Henderson, longtime friend of the show. Thank you for calling in and being with us today and sharing some practical tips for staying healthy and not letting our food budget getting out of hand.
All right. Thanks, Jim, and appreciate it. It was fun.
Thank you, Andrew. When we come back, I'm going to talk about a recent survey and top lessons we can learn from Gen Xers who reflect on costly financial lessons, and what can younger Americans learn and implement to avoid repeating their mistakes. So stay with us. This is More Living with Jim Brogan here on News Talk 98.7 WOKI.
Welcome back to News Talk 98.7's Brogan Financial Studios, where Jim Brogan is coming to you live with important news and advice to help you achieve your dream retirement. Get ready to learn and live. Here's your host, Jim Brogan.
For tuning in this week to More Living here on News Talk 98.7 WOKI. Catch us every Saturday, 9 to 10 a.m., again from 3 to 4 p.m. right here on News Talk. You can also podcast all our shows. Go to Apple Podcast or to Spotify. Type in More Living with Jim Brogan, and then you can download those. We have those up typically every Tuesday. So if you missed part of this show, you can download it. We've got several years worth of shows on our website. In our final segment, I want to talk about the $100,000 lesson that we can learn from Gen X. financial regrets that weigh on their retirement outlook. A new survey from the CFP board, the College of Financial Planning, the Certified Financial Planning Board, reveals that financial regrets have cost the typical Gen X American nearly $100,000, which is a very sobering figure. The study was conducted in July and August, and it really highlighted the enduring impact of early financial decisions, with Gen Xers now reflecting on the choices they made during their formative years in a period that was marked by the rise of 401k plans and the challenges of the Great Recession. So according to the report, 95% of Gen Xers say that their financial missteps have cost them money, with a median loss approaching $100,000 over their lifetimes. 95%. And more than one-third estimate their regrets have cost them between $100,000 and $500,000. Now, what were some of the biggest regrets? The most common, shared by 33% of respondents, not starting to save for retirement early enough. You know, the most significant takeaway is that it is never too early to start planning for retirement. You know, 43% of the respondents admitted that in their 20s and 30s they believed they had plenty of time to prepare for the future, and it's a misconception that has proven very, very costly. And it's understanding the time value of money, the power of compound interest, and the value of starting early. Some other mistakes. Many report looking back and thinking things like credit cards were a good way to fund a lifestyle, or believing that budgeting was only for people who struggle financially. I mentioned that in our last segment about the importance of budgeting for our grocery, planning ahead. Andrew Henderson, Fitness Together, talked a little bit about that to manage our grocery costs. But budgeting, understanding where the money is going is so critically important. And, you know, especially when you prepare for retirement and have to determine what's your retirement income need, you have to know what you're spending. And so I think if it's intimidating to try to figure that out, just start tracking it for the next 4 weeks. And another way is to just look at how much money is hitting your checking account. You know, your gross pay doesn't really matter much. It's what are you, in terms of determining your budget, because you're contributing to a 401k, you have payroll tax, you have other taxes being taken out, you have health insurance deductions, you have all these things. How much is actually hitting your bank account on a monthly basis, and how much of that are you spending? That's a really good way to really get hold on, to get your arms around how much money you're actually spending. And then, as I said, many Gen Xers thought in their 20s and 30s they had more time to save for retirement, and so there are ripple effects. The consequences of these regrets extend beyond bank accounts. Nearly half of the respondents of the Gen Xers say financial missteps have led to increased stress and anxiety. 37, almost 40% report a reduced sense of financial security. Other things, having an emergency fund. You younger folks, I know having an emergency fund, that money's not going to be beating inflation over the long haul, but it allows you to be more effective with all the rest of your money, because if you don't have an emergency fund and something comes up unexpected, you may have to borrow money, and you don't want to do that for short-term needs, or you have to cash in an investment, and if it's in the market, and what do you do if the market is sharply down? So all these things are critically important. You younger folks can learn from us Gen Xers with these types of things, starting early, not using credit cards excessively, having a budget, knowing where the money is going, have an emergency fund. All of those things are critically important. Today we've discussed finances because greater wealth provides for more living, so you can live the best years of your life your way. Next week, we're going to talk about Social Security, and we have special guest Hamilton Morales. He's out of the Charlotte, North Carolina area. He goes around the country doing workshops, teaching people about Social Security elections. So be with us next week. Thank you for tuning in this week. Thank you to Wayne for engineering the board. Thank you to Mary Caroline helping produce the show. You've been listening to More Living with Jim Brogan right here on News Talk 98.7 WOKI.
The views expressed by Jim Brogan and his guests are not that of Cumulus Media. Any discussion of financial, legal, and tax planning strategies is not intended to be individualized advice and is general in nature. Always consult with your advisor for advice specific to your needs. This program's content does not represent a recommendation of any particular security, strategy, or investment by Jim Brogan or Brogan Financial Incorporated.